Inflation has been eating everyone alive, and yet they still tell us that it's only around 3%. In this video, I'm going to expose the dark secrets concerning inflation, but at the same time, I'm going to show you how you can cash flow from it. Welcome to the AlterNate Vantage. My name is Nate, and this is where I provide a different look concerning financial literacy, news, and generational wealth. If you like this kind of content, then don't forget to like and subscribe. All right, back to the video. The most important thing concerning inflation is that it is a compounding number. It's not a numerical increase. A common math problem that gets presented to people all the time, just to test their financial literacy, is the following. Let's say you have two options. Option number one is to receive $10 million every single day over the course of 30 days, or you can start with a penny on day one, but the value of that penny will double every single day that goes by for the next 30 days. Well, if you're familiar with this math problem, then you already know the answer, and I'll show you how these numbers break out really quick. So, looking at the two options, you can see here, day one, you have someone who's receiving $10 million every single day that goes by. But the other person, they elected to start with the penny, or excuse me, the dollar, that is compounding every single day as well. And so if you look at these over the course of time, you're going to notice here, right around day 14 to day 15, all of a sudden, this dollar that was doubling in value every single day is growing at a pace faster than the other person who chose just to receive $10 million every single day. Well, if this trend continues, by day 30, the person who chose to receive $10 million every day over the course of 30 days will only have $300 million, whereas the person who chose the dollar that doubled every single day will have $536 million. This is the important thing to note when it comes to values that are compounding. Compound interest is so powerful. Inflation is a compound interest rate. Let me further explain. The best way to show you exactly how inflation works and how damaging it is, and this is honestly inflation's deepest, darkest secret, is just to show you if we had a simple inflation rate of, let's just say, 2%, and show you exactly how that breaks out in terms of just diminishing the value of your dollar over time and how that diminishing rate gets worse and worse and worse. So let me show you exactly how that works out, just showing you the numbers. Okay, so this is a chart that I made that kind of describes some of the effects of inflation and the numerous different ways that we can actually measure its impact. When it comes to what we see, like in the media, the only impact that we see are these two columns right here, the rate of inflation and prices. And if you look at this change just from one year to the next, it might not seem like that big of a deal. You know, as an example, from year one to year two, instead of things costing $1, now things cost $1.02. From year 2 to year 3, now they cost $1.04. And to a lot of people, that might not seem like a big deal, but this change in prices, like I said, it's a compounding number, and these other columns I'm going to demonstrate to you shows you how this effect is taking place. So here's the most important thing to realize first and foremost. Anytime you have a price increase, it also means you have a value decrease in that dollar. Meaning, if you had $1 worth of goods, right, you could only pay for 98 cents of what that dollar is asking for, or you can only pay for 96 cents or 94 cents. It keeps on going down. This is called your buying power. The number on the dollar says $1, but the actual buying power is only worth 94 cents. Next year, 92 cents. The year after that, 91 cents. And it keeps on getting lower and lower. This column right here represents the overall year-over-year price increase. And this is a very important metric to pay attention to, because we can see here in the first, let's just see, 13 years, first 13 years where we have a steady rate of inflation at 2%, the price increase is only 2 cents at a time, which makes sense. But once we hit year 14, instead of prices increasing by 2%, or excuse me, 2 cents, now they are increasing by 3 cents. If we continue down the line a little bit later, once we get to year 31, prices aren't going up by 3 cents anymore. Now they're going up by 4 cents. So once again, you're paying attention to this compounding effect. Prices are going up at a faster and faster rate. This column right here is showing you by percentage how much prices are actually increasing. So at year one, we can see we have a 2% inflation rate, meaning prices go up by a flat 2%. But the next year, even though we have an inflation rate of 2%, it's the exact same, prices actually go up by 2.4%. The next year, prices are actually going up by 2.8%. And this is how we're tracking these two columns right here. One is showing the price change, one is showing the percentage change. And of course, it's getting worse and worse. Prices are going up by 4% at a time. Now they're going up by 5% at a time. And yet, inflation is still only at 2%. This is the compounding effect. This is showing you the lifetime price increase. Okay, so this is showing you that we started at a price of $1. Well, by year two, they've already gone up 2 cents. By year three, we've gone up a total of 4 cents. By year four, we've gone up a total of 6 cents. So this is showing the overall aggregate price change. And this is just showing that number reflected as a percentage. And so these two columns here are really showing, or two pairings of columns are showing the true damage that inflation is incurring, even though we only have a flat rate of 2% inflation. And then this last column over here, this is reflecting the total depreciation, meaning the buying power loss that you had in your dollar and how much that is changing every single year. And as you can see, only a handful of years have gone by at this point where you've already lost 20% of your buying power just in a very, very short span of time. So let's see what happens over the course of just 53 years. And I'm not pulling that number out of a hat. I'm actually tracking that number back to 1971, which is when we went full on into the fiat dollar system. So if we only had a standard inflation rate of 2% over the course of 53 years, let's look at the damage in year 53. What's going on? Well, instead of prices being $1, now the average price is $2.80. Instead of your dollar buying you a dollar's worth of goods, now your dollar is only buying you 36 cents worth of goods. Prices, instead of prices increasing at a rate of 2 cents year over year, like it was just in year two, now prices are increasing at a rate of 5 cents. And you have to really measure this damage against the buying power that you have. Because if prices increase by 5 cents, and your buying power is only 36 cents, then you can kind of see how damaging that is very, very quickly. Percent pricing changes. That means prices in year 51, they went up 5%. In year 52, they went up another 5%. In year 53, they went up another 5%. Nathan, what are you talking about? Inflation's only 2%, so prices are really only going up 2% per year. Well, we have to measure the impact of inflation against the original value of the dollar, not its current value of the dollar. If you do a current value of the dollar, then things aren't going to seem that bad. And then we can see over here that the lifetime price increases. That means the overall prices have increased by $1.80. This is reflected in the total right here, $2.80 to buy anything. It's a $1.80 increase. That means the prices have increased by 180% over time. And you can't see it here. Let me scroll down for you. Annualized depreciation. We have already lost 64% of our buying power over the course of 53 years. And so this is where we are in our financial system. We're 53 years down the road of an inflationary, debt-based, debasement-based currency system since 1971. That's the end of the Bretton Woods Agreement. If you haven't looked into that, highly recommend it. I'll have more videos that come out and explain that. But here's the big issue and what I really want to show people. What's put out by metric is that we actually haven't been under a standard rate of inflation of 2% over the course of 53 years. We've actually been under a standard rate of 3% inflation over the course of 53 years. And that's by their measurements, which we already know are off. Well, if we just change 2% to 3%, that might not seem like a very big deal, but let's look at what's happening now in year 53. Well, now the average price of goods is now $4.65. That dollar you have in your pocket is only buying you 22 cents worth of goods. Even though inflation is only 3%, so prices are only going up 3% at a time, what's actually happening here is the aggregate like buying power or actual true price change is going up by 12% here in year 51. In year 52, it's going up by 13%. In year 53, it's going up by another 13%. Because once again, we have to measure it against the original value of the dollar, not the current value of the dollar. Lifetime price increases have gone up $3.65. This is a total price change of 365%. And the overall annualized depreciation is we have lost 78% of our buying power. Now, this table is not accounting for other factors that offset inflation, such as wage increases. Okay, so wage increases offset inflation by a very tiny margin, but in every single circumstance, inflation always outpaces wage increases. So it's really not that big of a deal at all. But in reality, like in the years prior, it wasn't that bad. Well, it wasn't that bad because we had appropriate wage increases and other price cuts, which offset inflation. But either way, it's still not a system that can functionally work forever because we simply cannot produce enough goods to offset the debt that we're putting ourselves in to try and beat inflation. It just doesn't work. Here's the reality that I really want to show you, and I'll just have it come up on screen. But if you want to look at the compounding nature of inflation, we've been on the Federal Reserve system starting in 1913. Overall compound inflation rate is over 2,900%, which is just absolutely insane. But this is why you cannot outpace inflation, because it is just killing you little by little. Okay, so as you can see, an inflation rate of just 3% of what they're trying to tell us is still going to crush you over the long term. Your retirement is not going to survive. Your general wage increases are not going to be enough. And bottom line is that this rate of inflation, what I haven't even talked about is what causes inflation, which is where we get some of the real deep backwards logic in fighting inflation. Okay, so here are the two things that cause inflation. Number one, the Federal Reserve printing money, and number two, banks issuing credit. Now, if we think about this for a second, right now, you have the chairman of the Federal Reserve, Jerome Powell. He's saying he's doing everything he can to fight inflation. How can the Federal Reserve fight inflation if the Federal Reserve is causing inflation by printing money? And they're still printing money. Just a little bit backwards. Same question. How can the banks adjust their rates to fight inflation when the banks are causing inflation by issuing credit? And by the way, we as consumers are somewhat guilty parties in this because we are the end all be all borrowers, right? You know, we take on this money in terms of credit, we put it into the ecosystem, and that causes inflation. But I'll give us a little bit of a break on that because we have been conditioned to do this economically by every single thing that we're taught in school when it comes to finances, even though we're not taught a lot in school when it comes to finances, because they're definitely not teaching you things like this. But here's the big thing. We are way too far, we are way too deep in this financial cycle for us to just be like, okay, well, let's just stop printing money, let's just stop issuing credit, we'll stop inflating the dollar, and everything will get better. No, the economy would absolutely implode on itself if that happened. We'd get sent into another Great Depression like the world has never seen. It would just cascade into all these other countries. It would be crazy. It would be wild, which is why you have, Jerome Powell and others saying, we're trying to go for a soft landing. That's, first of all, not going to happen, but it would just absolutely upset the system. So we can't do that. So then we have to, take what we are working with and say, okay, well, how can I, outpace inflation? How can I still cash flow in an environment where, real wage growth is just not going to keep up with these things? And these are some of the matters that I wanted to share with you so you can actually take advantage of what's going on instead of being taken advantage of. Basic principle is this: you need to place your money into assets whose value grows with inflation and whose cash flow grows with inflation. What are those areas? Those are areas which will always have a consistent demand by the people. Think about things that people have to have in order to survive. Those are going to be the most consistent things in terms of beating, or not beating, I should say, but pacing with inflation, and then taking the cash flow to be able to adjust for, account for, or even slightly perform better in the margins of inflation. You work in those spaces. So you're looking for areas, positions, assets that people will always need. A great example of this is real estate. Now, before I even talk about real estate, everyone knows we are in a real estate bubble right now, meaning the value of properties is inflated because of inflation, but it's also inflated because the current amount of supply and demand. It's completely upside down. Well, not upside down, but it's in a very, very bad place right now. We are in a housing bubble. So in terms of buying into a real estate property for the purpose of its value increasing, probably not the best time right now. But if you're looking at it in terms of a cash flowing asset that can generate a rent that can keep up with inflation or outpace inflation, depending on the size and units and locations you're buying this property, then it's still not a bad opportunity for cash flow reasons. But of course, you have to balance that with, if the housing bubble implodes, values go down. If you got debt on that property, you could be underwater on that debt. And number two, if a housing bubble occurs, that means we're going to see more job losses, which means your tenants might have an issue paying you in the near term. But generally speaking, over a long period of time, real estate does especially well to fight inflation. Next thing, which is just obvious, at least I think it's obvious, is gold and silver. Gold and silver has been a form of preserving wealth, holding wealth, and extending wealth for thousands of years. And there's a reason for that. Just as an example, show it up on screen. If you had 10 kilograms of gold back in 1929, it would buy you a home. And likewise, if you had 10 kilograms of gold here in 2024, then it would also still buy you a home. It has held its intrinsic value. People like to bash gold and say, well, it hasn't gone up that much in value or hasn't done this much movement. It's like, that really doesn't matter because it's still accomplishing its goal, meaning whatever I want to acquire with that gold, I can acquire with that gold anytime that I want to because the value will always be there. Another good place to put your money is in oil. And despite what all the green initiatives are trying to tell you, pretty much every other commonplace metric is showing us that the demand for oil is still going to increase over the next 20 to 30 years. And if that's being the case, increased demand, that means increased value, regardless of supply. There's so many things that we factor in here. So oil is definitely a place that you can place your money in when you're trying to beat inflation. Lastly is energy. This is semi-related to oil, but not exactly one-to-one. Energy is important because it's an area that people always need. You need power, especially if people are trying to get more electric cars right now. We need more energy. We need more infrastructure. There's going to be more developments coming in energy over the next 10, 20, 30 years. Energy is going to be another good place where you can preserve your wealth and also cash flow if you're putting it in a cash flowing side of the energy sector. For example, company that produces dividends or your own company or just regular investments in the stock market and things like that. So just remember, in times of economic uncertainty, which is where we are right now, no one really knows when the bottom's going to fall out, but everyone knows that it is going to fall out eventually. The best places to put your money is in areas that people have to use to survive. They have to engage in to survive. That's some of the best places where you can put your money because you can guarantee the demand is always going to be there. Other places like tech and technology and AI and things like that, these are areas that can have a lot of, quick and fast and speedily growth. But the issue is that a lot of these things classify as discretionary spending, meaning these are things that people don't have to buy. So if things get tough, things get tight, the economy gets into a very bad position, people are always going to cut out discretionary spending first, which is why you want to put your money in areas where people need to spend their money because you can always guarantee that demand will be there. So hopefully this video was helpful in understanding the damage of inflation, but also how you can beat and, cash flow in inflation. If you learned something, then, leave a comment, like the video, subscribe to the channel, share it if you want to as well, if you think someone else needs to see this so they can understand what's happening right now, helping you understand the causes and effect of inflation over a long period of time, which is where we are at right now. Once again, 53 years into this system. If you did find it helpful, then please, don't forget to like. That helps out the video in terms of getting out to more people. And if you feel inspired, please share the video as well. And of course, don't forget to subscribe if you want to stay in tuned for more material in the future. So with that, I'll catch you in the next one.